Hey guys, so today we're going to talk a little bit about cheating volatility and managing market risk. And the first thing I got to ask you guys is, do the current market conditions have you feeling a bit disconcerted or honestly downright nauseous? Now, the first quarter of this year had markets sharply negative and posted the first quarterly decline since 2020. This included both stock and bond markets losing money in tandem to the negative. So, what do you think about, and what do you do to position yourself for the years ahead, given kind of all the negative headlines and news that we've had? I'll first give a brief idea, and it has to do with the market side. So first, if we look at stocks, many stock analysts might say that the future year market returns will lag the last decade that we had experienced the above average returns since really the '08 crisis, which at the time prompted the Fed to increase its balance sheet by continuing to flood the market with funds through its open market bond purchases. We called that quantitative easing. And these analysts may likely argue that we need to take on more stocks and more risk, but allocate wisely, strategically, between a balanced mix of growth and value companies, as well as maybe steer the stock portfolio more towards international markets, which may recover and outpace the U.S. as the Ukraine and Russia conflict potentially here winds down. Now, there are other subtle tilts to a portfolio that one could argue would help put the portfolio in a best position possible, given all the possibility of future events occurring that we are, forecasting. Things like tilting to specific sectors or moving bonds to shorter term holdings. And none of these well-educated and well-intentioned arguments for these future investing allocations are wrong necessarily. But in my opinion, they don't do enough to address the risks involved, or perhaps more importantly, consider the behavior and feelings of the average investor. So with that being said, we need to look to alternative risk transferring products and investments to help us take risks where appropriate and adequately protect money as well. There are many different types of annuities, for example, but did you know that there are some that give you short-term guarantees that can completely protect your money from any downside loss, but give you a guaranteed rate of return for a specific time? Or did you know there are other annuities that have things like investment floors that allow you to participate in markets, but still guarantee that for a period of time, your money will be there at the end. Or how about things like risk-averse products like cash value life insurance, which has been around for decades and decades? What's the equivalent investment you might need out there in this kind of market environment to generate the same cash value growth of an insurance product to a future, fund a future goal? How much money do I need to really get out there to hit that goal? And so these are all like really important questions that help address some of the behavioral aspects of finance, not just the technical aspects of where to put money in this crazy market environment. This isn't a pitch to use insurance or risk-sharing products per se, but there are alternative savings vehicles that can give you peace of mind on some of your core capital, while giving you the permission to take risk in other parts of your money over time in the capital markets. So consider your options really carefully, and be sure, absolutely, as I mentioned, to read the details of not only what you're investing in today, but all these contracts. And when in doubt, look to another financial advisor or planner to help you explain the details of each alternative vehicle you might be exploring. So with that, I thank you for tuning in today. Hopefully you got a few ideas on cheating volatility and managing the current market risk. And if you could do something with the buttons below, we'd appreciate it. Visit us online, and until next time, have a great day.